Hey guys, how's it going? It's Andy from Magoo Investing and happy Wednesday. Today we're going to be wrapping up the four-part series that I've been doing, talking about the best stocks to buy from every stock market sector going into 2021. The first two videos were my opinions on Bank of America, where they gave their 11 favorite stocks. And then the video I did yesterday, I talked about the first 5 sectors. And if you missed that video, I'll link it above right now. And then we're going to be wrapping up today with the final 6 stock market sectors that I didn't cover yesterday. Are these my favorite 11 stocks to buy overall? No, but I think it gives a wide variety of stocks in all of the different stock market sectors. I've been seeing a lot of some of the other YouTubers that are making content talking about the stock market. They usually focus on 1 or 2 sectors. It's usually technology and the up-and-coming stocks that have a lot of upside. And I think it's beneficial to talk about all of the stocks in the stock market because not everyone's looking for these high growth stocks. Some people are looking for more conservative approaches to invest for the long term. And I think talking about all 11 of the stock market sectors gives that wide variety of stocks so that everyone can get some important information out of these videos. And since there are a wide variety of stocks in this video, there are timestamps in the description below if you'd like to bounce around between stocks. So before we get started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I really appreciate it if you hit the like and subscribe button, as it would help my channel out a lot. With that out of the way, let's hop into the first sector. We're going to be talking about information technology, where Bank of America picked Qorvo, ticker symbol QRVO, and I'm going to be going with Adobe, ticker symbol ADBE. Information technology is such a wide umbrella. It has all of the tech stocks in there, all of the service stocks. And so I could pick something like a Microsoft or an Apple that I think has fantastic upside, but I think it just gets talked about so much that I wanted to kind of spread my wings a little bit and talk about what I think is one of my favorite tech stocks out there, with Adobe, ticker symbol ADBE, which is currently trading at $500 and that's up 52% on the year. And so similar to the last video, I'm going to be doing 3 main points for why I like all of these stocks. And the first reason why I like Adobe a lot has to do with its really high margins. And so I really like investing in software companies because they usually have crazy high margins. And for people that don't know, margins are kind of how efficient a company is at turning revenue into income. And the higher that is, the better the company is at doing that. And with these software companies, since they're not having to spend as much on producing these actual products, the margins are usually a lot higher. And we see that a lot with Adobe. Right now, Adobe's net margin is at a recent high at above 40%, which is very impressive. And this makes sense when you see their revenue chart that has just been steadily increasing over time. When you break it down into their 2 main businesses, digital media makes up a majority of their revenue. And when you see that business, it has a gross margin of 96%. So this is the business that has to do with Creative Cloud, the way that I edit these videos with Premiere, Photoshop, that type of stuff. With those subscription services bring in a lot of the money, and since it is a subscription-based model, it has a gross margin of 96%. And with year-over-year revenue growth of 26 and 22% since 2018, this is an area that's expected to increase over time, and it's been growing at a rapid rate already. So reason number 1, high margins. And reason number 2, that it has no real competitors when it comes to their creative business. And so competition is good for when it comes to actual consumers because it forces these companies to innovate and come out with the best products possible. But when you're looking at the business side of things, competition usually results in lower margins because you're trying to price out the competition. And since Adobe doesn't really have any main competitors when it comes to their creative or their digital business, they're allowed to have really high margins and it doesn't really eat up into their profits. They have the best products out there, and since they lack that competition, that's how they result in having profit margins for their gross margin of 96%. And with their switch to the subscription model in the past decade, that has resulted in constant revenue streams, which I absolutely love. Reason number 3 that I like Adobe comes with their fight to try to take over the CRM market from Salesforce with Microsoft. And so I talked about how the margins for the creative part of their business at 96%, but their overall business is sitting at 40%. The reason behind that is that the CRM market is such a competitive market right now because it's growing at a rapid rate. From the numbers that I could find is that the CRM market is expected to have a compound annual growth rate of 14% until 2027. And as of right now, it's already massive. Salesforce.com, which is ticker symbol CRM, is probably the largest and the most exciting of these CRM stocks. But since they focus primarily on that, I don't like investing in CRM because there's so much competition in that overall sector, whereas Adobe's main business with their creative doesn't really have any competition. And recently, Adobe has been trying to take more of that market share from Salesforce. And the way that they've done that is with a deal that they had with Microsoft, where they're going to be partnering together to try to create an AI-driven CRM product. And so I absolutely love that. And when you partner these 2 massive companies that are very good at software and tech, I think it'll be a huge benefit for the company, and it should result in their margins significantly increasing over time because I think they're just going to only be better and take market share from Salesforce. So the 3 reasons why I love Adobe for a long-term investment: number 1 comes from their extremely high margins. Number 2 comes from the fact that they have no real competitors when it comes to their digital products for the creative. And then number 3, they're fighting to take more of the CRM market from Salesforce after a recent partnership with Microsoft. Next up, we're going to be talking about healthcare. And Bank of America picked HCA Healthcare, which I gave a big thumbs down. And I've decided to talk about Teladoc, ticker symbol TDOC. When I first was doing research for this video, I was not expecting to find anything in the sector that I loved. I don't love the idea of for-profit healthcare, but I'm a big fan of what I've been seeing with Teladoc. When I talked about the 2019 IPOs, I talked about how I really love the fact that Chewy, which is the online pet sales company, I love how Chewy has been focusing on the online telehealth visits for vet visits. And that's pretty much exactly what Teladoc has been doing with actual doctor visits. And they've seen incredible growth in 2020. And so with that impressive 2020, they're currently trading for $208 and they're up 149% on the year. So you've seen incredible growth. When I look at these stocks that have done very well in 2020, first off, I want to know why they've done well. And with a company like Teladoc, it makes sense because with the pandemic, people are not trying to go to the actual doctor's office because the hospitals are a little busy right now. So the number 1 reason why I like Teladoc comes from the incredible growth that they've seen in 2020. So obviously telehealth visits became significantly more popular during the pandemic. The company saw their total visits increase by 163% in the first 9 months of this year. And when you look at the data from the past 4 quarters, you can see the crazy growth that this company has had. And so once you see this incredible growth during this wild 2020, my next question is this sustainable, or is this going to be a one-off thing because of the situation with the pandemic? And when I look at number 2 reason why I like the stock with acquisitions, I feel like this is a stock that is going to be doing well going forward. And so for companies that have done well this year, I want to see them leverage their stock success into acquiring other businesses. And that's exactly what Teladoc has done. A few months ago, Teladoc announced an acquisition with Livongo that focuses on digital health monitoring tools for mainly the older generation with chronic problems. And while the stock market didn't exactly love this and the stock fell 10% because of this news, I think this was mainly a result of the fact that it got rid of a stock because they were acquired that has had incredible growth in 2020. Livongo was up 400%. And so people don't like that because it usually slows down the growth and hype between these 2 stocks. But when I look at the long-term potential of the company, since they've been able to leverage the success of their stock price in 2020, they were able to buy out a Livongo in an all-stock purchase, which is what I absolutely love to see because it shows that they're looking more to the future instead of just focusing on the incredible success that they've had so far this year. And so the number 3 reason is probably the biggest reason, has to do with a change in market sentiment and their compound annual growth rate. So as I mentioned, 2020 has been great for them, but how are they looking going forward? And when I see a stock that has a one-off year, I want to see growth going forward. And the numbers that I've been seeing seems very impressive. And so this graphic shows the huge jump in telemedicine users in 2020 and how it's expected to grow over the next couple years. And so it's expected to grow at a compound annual growth rate of 38% from 2021 to 2025, which is a massive jump. And so when I see that, when you have the leader in this sector for telehealth and you see a compound annual growth rate of 38%, they're likely going to be the leaders in this sector going forward in a market that's only going to continue to expand. And so Teladoc estimates that the total market right now is $120 billion of potential, but right now they only have a market share of 1% of that, meaning that they are still a smaller cap company that has a lot of room to grow going forward, even though they have doubled so far this year. Right now, surveys that I was finding found that 76% of consumers are interested in telehealth, well, that number was only 11% before the pandemic. So what we're seeing with the pandemic is that we're seeing a changing sentiment towards telehealth and how it's going to be more popular going forward. And I was very impressed to see that 43% of seniors plan to use telemedicine after the pandemic is over. This was a kind of a question that I had going in because obviously when you put the older generation and technology together, you don't expect to see a lot of success, but seeing 43%, that is a large base to expand their products to. And so as of right now, Teladoc does have the risk of having a pullback going into 2021 when the pandemic eventually ends. But with the numbers that I'm seeing with the expected growth in the industry, I think this could be a great long-term investment, even though it does have a little bit of risk in the short term. So I'm very curious to see what you guys have to say about Teladoc, ticker symbol TDOC, in the comment section down below. Next up, I'm going to be going to industrials, where Bank of America picked Alaska Airlines, ticker symbol ALK. I did give that a thumbs up, and I thought about mentioning Southwest Airlines because this is a stock that I own and absolutely love, but I wanted to go away from the actual airline industry because I talked about that at depth in yesterday's video. And so I decided to talk about another stock that has a huge bounce back potential with Boeing, ticker symbol BA. Currently, Boeing is trading for $221 and it's down 32% on the year. And so this is definitely more risky compared to the other airlines. But the number one reason why I like the stock has to do with the discount. And so this is a massive discount as a result of the two 737 MAX crashes in the past 2 years and the resulting groundings of those planes. And then the pandemic happened and that removed a lot of the demand for the new planes that was already pretty much at a low because of the lack of confidence with the MAX planes. Looking at the all-time chart, you can see how significant of a discount this is. And with the importance of this business to the US economy, to the airline industry, and to the US government, I think this could be a great bounce back potential, and I think this is a stock that you could consider to be at a discount. The number two reason why I like Boeing has to do with its government protections with bailouts and defense. And so Boeing is one of these companies that benefits the most from the US government and defense contracts. The numbers I could find is that Boeing was the largest US exporter. They benefited a lot from tariffs and competition relief against Airbus, which is their main competitor. And so as a result of that, Boeing has a lot of support from the US government. They are a US based business. And so this is not something that I think the government will let slide or decline anytime soon. In addition, Boeing has some of the largest defense contracts out there, just below Lockheed Martin, which is ticker symbol LMT. From the numbers that I could find, in 2017, they had $23.4 billion in government contracts that accounted for 1/4 of their overall revenue. And what we know about the US government spending is that they're likely not going to be touching the defense budget anytime soon. What this means is that Boeing is going to have consistent revenue streams with the US government contracts, even if maybe we don't see the recovery in the airline industry like maybe we kind of expect. Speaking of that, the number three reason has to do with the recovery of the industry and the reason I think it is a bounce back stock. So while the pandemic obviously was not good for Boeing because it kind of made the demand for their planes go to a zero, it could be argued that it helped negate some of the problems with their 737 MAX planes because there were groundings already because the demand was not as high. It maybe have helped them for a bit. And so these planes are grounded for 18 months and they have now been given the okay to fly from the FAA. And those first flights with the 737 MAX planes are expected to happen towards the end of this month with American Airlines. And while many airlines have canceled their 737 MAX orders, we recently have seen Alaska Airlines, ticker symbol ALK, make some deals to replace their Airbus planes with the new 737 MAX planes. And so hopefully, with the pandemic ending in 2021, this could be a decent recovery play. And since this is a stock that has a lot of risk, I wanted to talk about some of the downside and some of the risks associated with it. And so one of the negatives that I could see is that there's been a lot of scrutiny about the airline industry and Boeing with the amount of stock buybacks that they've been having, considering that they spent so much money on the stock buybacks, which could be some of the reason that explains the incredible increase in price. I'll put up the 5-year chart again, that had it shoot up to $400 a share. And so there has been a lot of scrutiny behind that. And at this point, stock buybacks are not going to be coming back anytime soon for these airlines because of the huge risk that it puts on the company. And so it does have that. Also, you have the 737 MAX planes that have a lot of uncertainty behind it. And so this is a stock that I see as being a great long-term play. It was my favorite stock to buy going into 2020. Then the pandemic kind of hampered that a little bit, but I still like Boeing for a long-term investment, even though it is pretty risky in the short term. So next up, I'm going to be talking about real estate, where Bank of America picked Realty Income Corp, ticker symbol O. And I'm going to go with Innovative Industrial Properties, ticker symbol IIPR, which is currently trading for $186 and it's up 145% on the year. So the number one reason why I like the stock has to do with its track record. It is up 145% on the year, and the 1-year chart is very impressive, and the 5-year chart is even better. And so this is a company that's been rapidly expanding. At the end of 2019, they had 46 properties in 14 states, and now it's up to 64 properties in 16 states. And in the past, they've seen a 1,400% increase in revenue in the past 3 years. So as I mentioned, this company has a great track record for the stock, and they are rapidly expanding. Number two reason why I like the stock has to do with the dividend. This is an REIT, meaning that by law, they are required to pay out 90% of their net income in the form of a dividend, which currently gives them a dividend yield of 2.9% after raising it by 6% in the last quarter. And so 2.9% isn't on the high end of some of the REITs that you can find, but when you put that together with a 145% increase that the stock has seen in 2020, it is just additional cash flow to put into your portfolio. Number three reason is it gives exposure to the cannabis industry. And so in my cannabis stock video, I talked about how I don't really love a lot of the weed stocks out there, the individual ones. How I talked about I like the ETF MJ and I liked IIPR. And so it's hard to find many cannabis stocks that have been doing well this year. And then going back even further, it's hard to find any that have done well over the past 5 years. And IIPR has a track record to back it up. They do have exposure to the cannabis industry, and the way that their business runs is that they allow the cannabis industry to get around the problems that are set in place, considering that weed is still illegal at the federal level. And what this means is that these companies are not able to get financing from banks. And so these weed companies are trying to rapidly expand. And so it's not a great time to be doing stock offerings because the stock prices are at recent lows, so you're not going to get incredible value from that. And so what they do is that these weed companies own their properties, they sell them to IIPR to get the cash flow, and then they lease them back to the actual weed companies. What this does for benefits for both sides, it allows the weed companies to expand rapidly, and it gives IIPR the steady revenue streams with their actual rent. IIPR is unique because it is the only weed REIT out there. It has incredible returns that will do very well with the expanding weed industry. This is an industry that's expected to grow at a compound annual growth rate of 18% until 2027. And so there are some risks, especially if weed becomes legal at the federal level. IIPR won't have the type of leverage that they've had in the past, but I don't see that becoming legal anytime soon. So I love IIPR. I think it's a great real estate stock. I also like ticker symbol O. I think it's also great. So next up, we're going to be talking about materials. Bank of America picked Vail. I give that a big thumbs down. And I'm going to be talking about Freeport-McMoRan stock, which is ticker symbol FCX. This is not an industry that I love very much because materials are a very cyclical business, but I did decide to pick FCX for pretty much one main reason. Number one is this is a stock that I've traded in the past. This was a stock that was recommended to me by my dad when I was first trying out the wheel strategy at the beginning of this year. And you can see how volatile the market was at this point from the returns I was able to get on some of my options. My first trade, I was able to get 5.5% on a put that only lasted 10 days. And then a month later, I sold a 1-month put and got 13% from it. Obviously, I missed out on a lot of cash considering these trades were at $5.50 and $8, and now it's sitting at $25 and it's up 91% on the year. So I did miss out on a lot of that, but there is a type of confidence that happens when you're looking to invest in a company that you've owned in the past. That makes me feel more confident compared to some of the other material stocks out there, and I have not found a lot of them that I absolutely love. And so the number two reason has to do with copper prices. Similar to what I talked about with Vail, a lot of these material products, gold, iron, copper at recent highs, and copper is at a 7-year high. And so since copper makes up 52% of their overall revenue, this has resulted in huge spikes in price, especially in November, where I think they saw a 25% increase in their price. They do stuff with gold and have exposure all across the world, so it does give them some diversification of their portfolio. But it's hard for me to really like a materials company for a long-term investment because it's such a cyclical stock, and I don't really feel confident buying into these types of companies, but I will put FCX as my favorite material stock out there. And then finally, we're going to go with utilities. Bank of America picked NextEra, and I'm also going to be picking NextEra, ticker symbol NEE. Currently, it's trading for $75, and it's up 24% on the year. And since I've talked about it twice in the past 2 weeks, I'm just going to give a quick summary of what I like about it. Number one, it's the U.S. largest energy company. They took that spot from ExxonMobil, ticker symbol XOM, back in October. They have enough capacity to power Greece, or 10% of the U.S. It has a great track record over the past 5 years when I put up this chart. And then when I go to the all-time chart, it's even better. So it has a lot of stability, and since it's the largest energy company in the U.S., fantastic. Number two has to do with their work with renewables. They have a large focus on renewables, which is very attractive for someone like me. They are going to be spending $1 billion in energy storage in 2021, and that is expected to be the largest investment in a single year for energy storage of any company ever. And so they're also starting to work with hydrogen power, and that'll be exciting after they've seen incredible success with solar and wind energy. They also have a dividend of 2%, which is a nice bonus, and they've raised that for 25 straight years, making them a dividend aristocrat. So I've already talked about them in a couple videos, so I just wanted to give my summary. So overall, those are my 11 favorite stocks from each of the stock market sectors. We had some good ones. I didn't absolutely love Bank of America's list. From the track record that they had, all of these stocks that they picked in 2019 going into 2020 underperformed compared to their overall sector. So hopefully I'm going to have a better track record at the end of this year compared to Bank of America. So let me know what you thought about my list, and let me know what stocks you guys are looking to buy going into 2021. I'm probably going to be taking the rest of this week off. I may be planning a fun video to go up on Saturday, but I will see you guys in the next time I upload. So thanks for watching, and thanks for supporting the channel.